Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 170th VideoCast, 160th podcast for the week ending January 19th, 2023. We have a lot to cover today, so we'll quickly do the media, and then we're going to get right to it. So first off, I'd like to thank Zoltan Saranyi and Mitch Hawk for having me on Benzinga. We're going to actually play that in just a second because it was a great interview. Anytime I go on Benzinga with Mitch, he just goes into such depth with the questions. It covers the overview all in one spot, and then we're going to get to a lot of charts, a lot of Ask Me Anything questions, and a lot of new data. So we'll click over to that in just a second. I want to thank Phil Yin and Jacqueline Pham for having me on CGTN America. I'd like to thank Shriyashi Senyal and Amruta Kandagar for having me in Reuters this week. Want to thank Hyunju Jin, Victoria Waldersi, Zhang Yan, Zoe Zhang, Bansari Kamdar, Samuel Indik, Gertrude Chavez, Kevin Krolicki, Peter Henderson, Alexander Smith, and Matthew Lewis for having me in Reuters. Want to thank Bansari Kamdar again, Noor Hussain, Hannah Lang, Shunak Desgupta, Nick Zyminski also for having me in. And the Warren Buffett quote of the week: the stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. The problem when you're a money manager is your fans keep yelling, "Swing, you bum, swing." So we'll talk a little bit about that this week. But first off, just to get you a broad overview, because we've had this monster move, first off the October lows. Now we've been consolidating for about 6 weeks, and everyone wants to know what's next, because we've had that pullback yesterday and today, and we cover it right here. So on to Benzinga. Take a listen right here.
All right, let's bring on Tom Hayes here, managing member at Great Hill Capital. Welcome back on. How we doing, Tom?
I'm doing great, Mitch. Good to talk to you as always.
It's always great to talk to you. Of course, it looks like today we finally ran into the wall. Some might call it the January effect wall is what I'm referring it to a little bit. It looks like, I have the question now, and I feel a lot of investors are asking this question. Is this more a pause in the recent action, or more along stocks starting to show at least a reverse from the recent rally?
Yeah, it's a great question, Mitch. It's the $1 million question. I do think that we've had a 15% rally off the October lows. It's time to have a little bit of a consolidation. The move is a little bit exhausted, but people are still off sides. And I do think after we get through this short-term consolidation, whether it's a week or so, the path of least resistance is higher. I think we'll consolidate short term. And keep in mind, Q4 earnings season, although it just started, it's basically going to end in a few weeks, okay, after we get major tech earnings. And I think what's going to change about that is 2022 is no longer a factor. And then you have 2023 earnings, which right now are, 229.52, which is consensus. And people are saying, oh, well, if we're going to get slowdown, 17.2 times multiple is too high. But the minute those Q4 earnings roll off, we're no longer going to be focused on current year earnings. We're going to start looking forward to 2024 earnings, which are at 252.74. And in that case, we're only trading at 15.6 times 2024 earnings. And I think that shift is going to start to happen in coming weeks as we get through earnings. The other thing to keep in mind with earnings, Mitch, which is very important, everyone had very, very low expectations coming into this earnings season, negative 4.1%. But if you look at the Atlanta GDP now, it's saying that GDP grew in Q4 at plus 4.1%. So that dog don't hunt. Either GDP expectations are too high or earnings expectations were too low. And we think earnings expectations were too low. We're going to have a positive surprise to the upside. Guidance will be a little bit better than expected. And then we start to look forward to 252 in 2024. And that's when people start to say, wait a second, there is value here at 15.5 times. We'll have consolidated. And by then, maybe the Fed will be done with their hawk talk. We were doing just fine after PPI until Mester got on the horn and Bullard got on the horn and talked the market down this morning. That's the bad news. The good news is neither of them have a vote moving forward. So their words are pretty much meaningless.
All right. Now, one thing I have been looking at, of course, is that we've been seeing kind of the amount of layoffs continue to grow, right, in the tech. Are you concerned that this is going to show up further down into earnings, right? I mean, it just seems to kind of make sense. If they're laying off, do they expect trouble going forward?
Yeah, I think this is actually very positive because number one, they'll take the one-off severance, like you saw a $1 billion charge with Microsoft this morning.
Yeah.
But what you're going to see, and we talked about this in December, is you're going to see a slew of these announcements. You know, Microsoft 10,000, Amazon you've seen, Salesforce you've seen, and you're going to see more and more, and they're all going to come in January because no one makes layoffs in December before the holidays. And what that is actually going to do that no one's really paying attention to is you're going to start to see political pressure heat up very, very quickly, particularly if you think about where most of these layoffs are concentrated in Nancy Pelosi's constituency in San Francisco and the whole tech area of California. And you're going to see politicians start to come out and really rail into the Fed. If you thought Trump was hard on Powell when he was in office, these Congress people are going to start coming out and say, you've tightened enough. It's evident that inflation has collapsed, is rolling over materially. You have to take into account the lagged effect. There's no reason that we should have hundreds of thousands of people laid off unnecessarily just for you to try to rectify an egregious error that you made last year by saying it was transitory and the Fed funds rate wouldn't go above 1%. It finished the year at 4.25%. We found out inflation wasn't transitory, and now you're overdoing it to the other side. So don't make two mistakes. One mistake was enough. You could actually declare victory, say we're going to keep rates elevated at these levels like they did from 1995 to 1999. They kept the Fed funds rate elevated at 6.5%, and tech did exceptionally well during that period. So they could keep rates elevated. Maybe they do another 25 basis points and pause and keep it there at 450, 475, for 9 or 12 months, see how the economy absorbs that. And my guess is if they did do that and they stopped in time and created a soft landing, they could keep the Fed funds rate there for quite a long time, maybe many years. But if they go too hard, they're going to just have to cut again, cause a recession, and start all over, which would be an egregious error.
Well, it seems like you're in the camp of what the Fed Watch tool is now showing, right? 94.3% probability of a 25 basis point hike at the Fed's next meeting. Of course, there was a lot of people still hawking on 50 basis points. So interesting to see that starting to get that high. Do you have that high conviction also, kind of more, I wouldn't say maybe 90%, but what do you feel about that outlook there?
Yeah, well, we've always been in the 25 basis point camp. They should do zero, but that would make too much sense. And why make one mistake when you can make two? So they'll go for two, and then they'll have to stop sooner rather than later. Maybe an intra-meeting announcement that they're going to pause as they see the data roll over. I mean, retail sales negative in December during the holiday season. I mean, you don't need to know a lot more. Manufacturing production came in worse than expected today. Industrial production came in worse than expected today. Retail sales came in worse than expected. PPI is negative 5.5% month on month. You annualize that, you're negative multi points there, and apparently they're just not getting the message yet. So hopefully by the February meeting, they'll be getting enough pushback from politicians that hundreds of thousands of layoffs are unnecessary, and they'll calm down, and they can keep it elevated if they want to keep things restricted. I think that's a good idea. Keep things restrictive. Don't get too easy too quickly, but you don't need to go much tighter than you are now.
I wonder, right, if Powell was kind of giving us a little bit more of that forward outlook with kind of his recent comments that came out of the conference when he was saying that it's going to be like unwished decisions, like the decisions that he's going to be making moving forward aren't going to be some favorable ones. Let's hope that's not the case. Let's move forward. Let's get into an area that you've been all on top of, Tom. Definitely got to give you the shout out for that. And that's talking about the China trade, right? Let's talk about this. Is this pullback that we're getting today an opportunity, or has this trade gone too far?
In the long term, it hasn't even started. In the short term, it's got to take a breather and a consolidation. So, companies like Alibaba, which we've been buying for months and pounding the table for months, and averaging in. Our last purchase was at $61. Our basis is higher. But we think that the intrinsic value of this, sum of the parts, when you look at the cloud business right now, is where AWS was, Amazon Web Service was in 2016. We think that's going to add another $10 billion of operating income to Alibaba, which would mean a 66% increase over their peak when it was trading at $319 a share. Moving forward. Then you got the Ant Financial IPO now that's going to happen within 12 to 24 months. They had the change of control. All the actions have been taken. That's the largest financial services business basically in Asia. And you own a third of that as an Alibaba shareholder. And then finally, the missing piece that is what catalyzed the trade was the dollar stopped going up. And that was the secret to emerging markets. The dollar's weakened about 10% in the last few months. And companies like Alibaba are up 95% off of their lows. Then you get Ryan Cohen, Mr. Meme himself, but also a multi-billionaire, step into the stock. We found out yesterday through the Wall Street Journal, he's bought a few $100 million of stock, and he's telling the company you should buy back more stock. And I'm adding to that, not only should you buy back more stock, you should stop buying back and then giving it out to management at stockholders comp, and respect equity holders. Do cash bonuses and let the buybacks be accretive to shareholders and increase earnings per share and drive the stock over the next few years. So to answer your question, it's probably got to take a breather after moving close to 100% in 2 or 3 months. Maybe that's days, weeks, I don't know. But when you look 2-3 years out, this is going to be a much, much higher stock, and it's going to revert back to its intrinsic value, which is meaningfully higher from here.
Yeah, there's not many stocks that you see a lot of the moving averages starting to even turn. You're seeing the 200-day start actually going to the upward angle. That hasn't happened in a long time. So we'll see what happens here, especially on, the overall China trade. You could look at FXI. Similar, it gives you that outlook there. We'll look to see if we get some pullback opportunities here, Tom. Appreciate you being on top of this trade, definitely, and bringing it to the audience. Let's get out of the China trade. Let's continue. Let's talk about what's going on in Moderna. It looks like, of course, they're just putting out more kind of vaccines. They're not just COVID anymore. I think this is the important thing. What do you think about a stock like Moderna?
Look, we love biotech for 2023. We built up a position in late 2022. It bottomed in May. The sector bottomed in May of 2022, several months before the overall market bottomed. And we think our thesis was predicated on the fact, number one, we buy a basket because we don't think we can predict which company is going to get approvals when, or which companies are going to get taken out. But when you buy a basket and the group is at historical low valuations, which it was in 2022 and still is, you can really, really benefit moving forward. So the two catalysts there are, number one is drug approval. So you've seen some major approvals in the Alzheimer's space, which means that you're going to see more and more money come in and want to get involved. You're seeing blockbuster drug approvals. Moderna has this special vaccine mechanism with the mRNA. We saw it with the recent approval last night. But we like the basket. We wouldn't want to put our money just in one name like Moderna, because all of these companies are going to be racing to the finish line. Vaccine first, but Moderna's was, it did exceptionally well also. So I think you just want to have exposure to the group because the group is historically undervalued. And moving forward, you're going to see a lot more drug approvals now that the FDA is focused on their normal actions. For 2 years, they were just focused on COVID. And you're going to see a tremendous amount of deal activity. Even in the slowdown in the fall, you saw major deal activity. Big Pharma is facing patent cliffs. What they have is a lot of cash on their balance sheets. What they don't have is a lot of growth moving forward. So when would be a better time to buy growth than biotech, which is trading at historically low valuations? And you saw a bunch of deals in late 2022. You're going to see a lot more in 2023. And that is going to drive more and more institutional flows into the biotech sector. That is a key position for us. We've got China, Alibaba, we've got that. And we've got some special situations in the US as well.
Love it. And I definitely like how you pointed out there the bottoming of the sector in 22. I know that you always like to stay and looking at that weakness to try to catch some opportunities. Any concerns for big tech earnings, or maybe this is a rotation that we should be looking at? I know a lot of people are concerned about these big techs. Are you?
There's none that I love except for Amazon. So Amazon is trading back at 2018 levels. We've been talking about Amazon for 4-6 weeks. It was down to 85. I think I don't know what it is today, 95. So it's just starting to move. But basically, you're buying at 2018 prices. The difference is the Amazon Web Service business has tripled over that period. Their ad business has tripled over that period. Their e-commerce business has doubled over that period, and their Prime membership has grown from 100 million to 163 million members, and you get it for the same price. So why is the stock trading like, you know what? Number one, interest rates went up very, very quickly. That's fine. But number two, they overexpanded warehouses during COVID. They thought that it was going to be an unending growth where people would stay home forever and never go back out to stores. That's unrealistic. So Jassy will fix that. He'll normalize the warehouse costs. As a matter of fact, there was an article that probably major layoff announcements are on the way. They'll take the one-time charge for the severance. That'll add to their margins. There'll be a leaner, meaner machine moving forward. And we certainly like Amazon. Now, if you look at the Bank of America Fund Manager Survey from yesterday, which I'm sure you saw, Mitch, managers, 750 billion of AUM, about 250 managers managing that, have their lowest U.S. equity allocations since October 2005, August 2010, and September of 2017. In all those three instances, you want to be a net buyer. The other thing that people are getting faked out with the general indices, if you look country by country around the world, many countries are at or near new 52-week highs. Mexico is breaking out. The UK is breaking out, which everyone says they have the highest inflation and the biggest recession. All of these countries are breaking out. There's only two indices that look like garbage right now. Number one is the NASDAQ, which is the five FANG stocks. And number two is Israel, which is a tech-based index. So ex-tech, everything else is in a new bull market. And what that means is tech will follow. It may slightly underperform, but many of these names have come down so much that their rebounds, even if they underperform the general indices, can be material. And that's why we like Amazon. We like the things that are left for dead. I mean, Amazon was down 55 some odd %, one of the best businesses in the world, historically and prospectively in our view.
Definitely appreciate you like always, Tom. I'll sneak one last in that I wanted to talk about, which is we don't do it too often, but the industrials, they've stayed strong. Specifically, we could talk maybe Deere and Cat that have really stayed strong, or we could just do the XLI, right? I mean, that's really been an area that I have seen strength as of late. Is this area an area that you're looking at this year, or is this more along just kind of a trade that has come, maybe a little bit of a value trap waiting?
Yeah, I buy weakness and sell strength. I know there are a lot of traders out there that like to buy strength and sell weakness. The big money is made in buying weakness and holding for a few years, both from a tax standpoint and from an economic standpoint. So Cat and Deere and many of the industrial names have had huge runs last year. That's when we were interested in them. We're much less interested. If you have to be in the vicinity, we would actually look at some of the defense stocks that have gotten slaughtered this week on fears of the debt ceiling fights, that they're going to cut the defense budget. The one thing that you need to know about politicians is where they get their money from. Defense is one area and pharmaceuticals is another. So I think the probability of them doing meaningful cuts in the defense budget, particularly given the geopolitical concerns we have around the world, are relatively low. Maybe there'll be modest cuts, but the way these things have sold off in recent weeks, I think there's opportunity in the Northrop Grummans of the world, maybe the Lockheed Martins, and that's as close as I would get to industrials. I mean, with Cat and Deere, they've had these monster runs. I'll leave that to someone else to play the breakout for a few points. I like to buy them when they're in the gutter, like Amazon and Alibaba, and make 200, 300, 400% over 3 to 5 years. That's more my style.
All right, the chat will kill me if I didn't ask a little bit about oil. What about that? I know that China's kind of reopening. That could help some of the demand, but is this more along something that has just gone too far, and we're going to see that rotation coming soon?
Yeah, I'm agnostic. We were pounding the table long energy stocks in 2020 when oil was trading at negative 30 and you couldn't give them away. That's when we buy them. We laid off early in 2022, probably a little too early, but you can't be a pig. And energy stocks would have to come in a lot more for us to reload, which we don't think is outside of the question. I do think certainly China demand will be material, but at the same time, the U.S. rig count is now just at pre-pandemic levels. So while everyone looks to Russia and Saudis for production, what they're forgetting is that our production, which had been cut by 66% during the pandemic, is now back at pre-pandemic levels. And that's recent news that not everyone has in their models. So I do think China demand is material. I also think U.S. production is material. So we remain agnostic on oil.
Well, definitely, you guys in the chat, hit the thumbs up. I hope you guys appreciated that. Tom hitting every single area that I could think of to get into the markets today. Appreciate you, like always, Thomas Hayes. Check him out, guys. Chairman and managing member, Great Hill Capital. And you guys can always give Tom a good follow. He's a great one on Twitter. Appreciate it, Tom.
Thanks so much, Mitch.
All right, let's get.
And we're back. So that kind of gives you the general overview, so we can just skip right past that. A couple data points I want you guys to look at. First off, retail has net sold all of the S&P 500 and NASDAQ 100 stocks accumulated from 2019 to 2021. So they are completely flushed out. That is usually the sign of times when you want to be a buyer. They were that flushed out in February of 2020. And they're completely flushed out right now. Also, this is a chart from Yardeni showing the relative valuation with S&P 600, which is small cap stocks, trading at their lowest levels relative to large cap stocks, 13.2 times forward earnings versus 17.3 times forward earnings. We've talked about small caps in recent weeks. This just shows the China tech stock rally since we've been pounding the table here for those of you who have been with us for some time, and you just heard with Mitch. But it's about a $700 billion gain in the last couple of months. And as I said with Mitch, just getting started. So we'll have some fits and starts. We got to consolidate after moving 100% in a few months. But the intrinsic value is many multiples of where it is right now. This was another thing from Ned Davis Research, which shows a breadth thrust, which we got on the 12th, and it shows the average returns, year out are just under 20%, about 18.9%. And there are very few false positives historically, if any at all. So that was positive to see. This is the ratio chart. So we've been talking about discretionary and communication services. We started telling you guys last week we were setting up for that because of everyone was jumping into energy and industrials after they'd already moved. The earnings growth in 2023 is all concentrated in sectors people don't want. Communication services and consumer discretionary off a low base. You start to see discretionary already working. This is relative to the S&P 500. You're starting to see some relative outperformance. Whereas healthcare, the big healthcare, have already had huge moves and they're coming off the top. Then you've got utilities already had huge moves. Staples, all the defensives had huge moves. And then here's tech, which is really just basically as bearish as people are. It actually looks like it's just been consolidating an overshoot from 2020 to 2021, consolidating sideways for 2 years relative to the S&P, performing in line, just touching this 200-day moving average, and possibly setting up for some action. I do think they could underperform moving forward, but I don't think, everyone's got this recency bias attached to the 2000 tech wreck, and I just don't see it because the earnings power of these businesses is unimpaired. Some of the multiples are too high. Some of the ones that are losing money don't touch. But we've just talked with Mitch about Amazon. So industrials, everyone wants to jump on board. They'll keep going, but this has been a big move last year. Relative outperformance has probably got to take a breather, as we discussed with Mitch. You could see he was asking about all the things that have already moved. We like the things that no one wants, like when we were talking China, you couldn't give it away. When we were talking energy in 2020, you couldn't give it away. Banks couldn't give it away. Amazon just a few weeks ago, you couldn't give it away. Disney a few weeks ago, you couldn't give it away. So that's when we like to buy. When you can't give it away, we want to help people out and take what they don't want. And when they want it again and they can't get enough, we'll be happy to help them out at that time as well. Here we go with energy again. We laid off a lot in early 2022, so we were buyers down here, and then we were sellers here a little bit early, but it hasn't done much on a relative performance. It's got to rest for a while. We'd love to see it pull back down to here in relative performance and then reload for the longer term because we do like the story. And here's communication services, the Amazons, etc., that other big earnings tech bottomed out at the end of the year in October and are now starting to relative outperform again. And that's where the earnings power is, which we'll cover. Everyone's talking materials after it had this big move at the end of the year. Sold to you, no interest. Biotech bottomed in May. It's just working up this thing just like it did in 2016 to 18, relative outperformance, and that's going to persist. And we'll be laying off up here when everyone else wants it again. Bonds, you couldn't give them away, long bonds. Now they're starting to bid a little bit. I think that'll persist this year. And KWEB, the China ETF, just getting started, ladies and gentlemen. Do we have to maybe consolidate a little of this? Maybe. But people are so underweight, maybe you get this type of consolidation and you push off and really start to hum. So we're excited about that. And then we also talked about real estate. If you remember, REITs, last shall be first. We've talked about it. No one wants it. Well, guess what? It's been outperforming since the beginning of the year. So that's how we think about things. Countries, all of you who are bearish, again, just want to reemphasize this. The rest of the world is in a new bull market. The only thing holding back and making people pessimistic in the U.S. is 5 stocks that make up 27% of the index. You take those out and you look at like an RSP, which is equal weighted S&P 500. Look what happens. You're about to break out to new highs. This is unbelievable. So this is just basically taking out the weight of FANG and tech, and you're about to break out. And what does it look like? It looks like the rest of the countries around the world, even Africa, reverse head and shoulders. Not that we're chartists or care about that stuff, but you just have to take note. Argentina, all-time highs, just ripping. I mean, who the hell would think? Asher, just getting started, broke above the 200-day moving average. This is the China A-shares ETF. Here we go. The Dow even. I mean, does this look like a bear market to you? I mean, above the 200-day, consolidating straight up, about to make all-time highs. Unbelievable. Wisdom Tree Japan Hedge ETF. Does that look like a bear market? Does this look like a bear market in Chile about to break up to new highs? This one does. Egypt is a little weak, but it broke above. It's checking back. Maybe. Ireland. I mean, this does not look. This looks like a double bottom and a breakout. Ireland. So Israel. This is the other one that I said looked like death. Why? Because Israel is tech weighted, but even that is starting to come around now. Philippines ripping higher. India doing fine. I mean, it's kind of looks a little like the Dow there. Peru. What else do we have here? Australia. This is not a bear market. Reverse head and shoulders breaking out. This is going to make all-time highs this year. I would bet on that. Canada. Canada, this looks like a reverse head and shoulders. Not much tech exposure. Other leadership problems maybe, but they'll be okay. Next is Germany. Same thing with China reopening. They're above their 200-day. This is not bear market behavior. Well, everything breaking out above their 200-day and following through, not bear market behavior. Hong Kong above the 200-day, breaking through. Italy, does that look like a bear market? No, that looks like it's going to make a new high in the next 12 months. Italy. So could these things go back and test the 200? Of course they could, but I mean, the key is the direction. I don't really care about the next 2 to 3 months. I care about the next 2 to 3 years. And for all the pessimism that we talked about in November and December when people were puking, we said, no, the rest of the world's doing okay here, guys. Let's pay attention. It's just 5 stocks that has you depressed. Let go of that and pay attention to the rest of the world. Switzerland, same story. Okay, so, we just go on and on and on. Malaysia, same story. Spain. I mean, this is basically it's 52-week highs. I mean, this is above 2002 levels, and it's probably going to make all-time highs. What else do we have here? France, of all places. Singapore. So you get the point, ladies and gentlemen. The rest of the world can't be doing this well, and the U.S. is going to go into a double-dip recession. I mean, stocks lead. They're a discounting mechanism. Even the UK, which is why people are so pessimistic, they say they have the highest inflation, the worst recession, and they're the ones that are closest to making new highs. They're literally $1 away from making new highs. This is mind-boggling. We haven't talked about our 2 major UK positions yet in a meaningful way. We haven't completed work on the second one. That's reserved for clients for the time being. But when that work is completed and we are, it's a meaningful position for us, we will potentially start to talk about that publicly. The other problem is we're not crazy about talking about smaller market caps when we can, avoid it. But I think there's very ample liquidity that everyone can. And some of you have figured it out already. But, if you're just jumping on without doing work, good luck. We're not done with our work. We've been working on it for weeks. We did a very strong starter position so we could participate. As a matter of fact, one of the guys that works for me said, well, how did you know there was going to be a catalyst? Well, it's very simple. When a stock is down meaningfully, call it 70, 80, 90%, and there's a change of management, and the stock's doing poorly, the one thing you can count on is that they are going to come out sooner rather than later, just to shore up confidence in investors, with a plan for the future. And usually that plan is going to include 2 things. Number 1 is massive cost cuts, and number 2 is the plan to resume growth. And they did both of those in spades, which is why it was up 20% that day. So you just want to be positioned for stuff like that. Now it's going to be a show me. So now you'll have a spike. You're going to have some consolidation. You're going to have time to build a position because the market's going to say, okay, show me what's happening. And the same will be true with Cooper Standard, which we'll talk about a little bit today. The financing expired last night at midnight, so we should get a press release within 4 days. They have to do by Reg FD. My guess it'll be sooner. I would have thought this morning, if not tonight, but my guess is what they're going to want to do is announce once they have received the funds and then use the funds to pay off the short-term debt and then make an all-in announcements, which could take a couple of days to do. So we'll see what happens there. We'll see where it settles out after that. And then the catalyst moving forward is they've got a 4-year runway to get back to $5, $6, $7 a share in earnings power and apply whatever multiple you like. Trough at 10 times, peak at 20 times. And you can see that there's dramatic upside moving ahead. And it's going to be dependent on industry volumes returning to 2017 levels over the next 3, 4, 5 years. And we think it could happen much sooner because the fleet is 13.1 years old. Mexico, all-time highs, unbelievable, okay? If Mexico can do it, America can do it, It used to be the other way around. Now it's this year it's opposite day. So South Korea, which is a barometer for the world, go head and shoulders bottom, breaking out. Measured move should be another 15 points to 75 for starters. All the CMTs must love me today. I'm talking charts. This is meaningless stuff, but when the fundamentals, and there's so much pessimism in the market, you have to separate yourself dispassionately and just look at the facts. The stocks are a leading indicator. Here's the Eurozone. This does not look like a depression or a recession or a hard landing. I mean, could the Fed screw it up? They're trying, but they're just, they're trying really hard. They're just not going to be able to do it. Greece breaking out to new highs. So, look, you get the point. Okay, Indonesia, the IDX is low. Why is that? Well, if you rule that people who aren't married can't go live together or can't stay in the same hotel room, who the hell's going to invest with you? So that's just a self-inflicted wound, unforced error, and hopefully they'll figure that out and rectify it so that foreign capital will feel comfortable once again. And if not, the money will go elsewhere. Money goes where it's treated best. And leave the morality for your churches and for your religions, but separation of church and state works best as far as we found over the last 1,000 years of history. Small caps, same thing. They're trying to get out there, and looks like a double bottom is in, and then we'll go from there. And remember the relative low valuations. K-Web again breaking out finally, double bottom, and off to the races. So look, over and over and over. And this is the only one that's got everyone depressed, is the NASDAQ. It bottomed here. It's testing. It will lag, and then it will follow through. This is what's holding down the S&P. But we're going to get tech earnings in the next 2 weeks, and I think they're going to be slightly better than expected. And for everyone worried about margins, don't worry about it. They're taking care of it with layoffs. I mean, that's you're seeing it. Amazon 18,000. I said this crescendo, like I just said with Mitch, you're going to see more and more. You saw a few more today. The politicians are going to come out and force the Fed to stop. Turkey, look at this. Remember we talked about that last year? This thing has been straight up double. All right, so there's, Vietnam also looks a little tired. There may be opportunity here, actually. If not for anything, maybe just the ETF we'll have to look at. We haven't found any companies that we really like there yet. All right, Jeremy Siegel says, Fed needs to end its aggressive inflation-fighting policy and stop hiking rates now. Similar argument, but eventually someone's going to listen to him. I wish he would just cover the brass facts, how this is nothing like 1970s or 1980s from a demographic standpoint, from an age standpoint, from a demand. This was supply-driven. Supply chains now with China are open. You're seeing it with semiconductors. You're seeing it with autos. That was our thesis with CPS. And the other thing is, for every point that they've raised the Fed funds rate, it's another $300 billion a year in interest expense. So do the math. 5% is $1.5 trillion of new interest expense. They can't afford it. When Volcker was doing this, and by the way, if they can't afford it, what do? They have to print more money to service the debt because they don't collect enough taxes to pay the new debt servicing. So it's more inflationary for them to continue raising rates than to just leave it here, let inflation run above trend. It'll tick down to 3%. At 3% plus, you'll have the debt to GDP will be inflated away from 120 down to 60, down just like it happened from 1948 to 1953. After World War II, debt to GDP got up to 120% as well, and they just let inflation run above trend, 3 to 5% for 5 years, normalized debt levels, and they were off to the races. Volcker had debt to GDP of 33%. He could raise rates to 20%, and it was no big deal. And that was the formula that worked for them. But right now, they need to inflate away the debt and run inflation above trend, or you're going to default. I mean, or it's going to be, a banana republic where they're just going to keep hiking rates and having to print money to service the debt. And no one's talking about that. And that's the most cogent argument to stop and wait, even if they keep rates elevated. Tanking biotech stocks will mean a big year for deals who could benefit. So they were down last year. As we've covered, pharma needs growth. They've got patent cliffs. They're going to be buying these left and right. This is going to be the year of biotech. Chips are the new oil, and America's spending billions to safeguard its supply. That's why I think this is less cyclical. Everyone, again, is stuck on recency bias of 2000 to 2002. I think they're going to miss huge opportunities in this group. Amazon leads rebound in battered tech as traders reload on risk. So, we were interested when it was at 85. No one else was interested. Now it's at 95. People are getting interested. It pulled back a couple points. People are puking. I think this is a good long-term play. This was interesting. This is Walter Deemer's breakaway momentum signal indicates really powerful upside momentum. He said, performance following a Whaley breath thrust in conjunction with breakaway momentum. That's really relevant here. One might call it a double-barreled buy signal, to steal a phrase from GOAT Marty Zweig. So basically, after this triggers, I don't really care other than the data behind it. After this triggers, you can see a year of trading days out, you've got mid-20 to high 30 across the board % gains, and we've just triggered that. The other thing is when it so the average is 26% gains, 252 trading days out. Median is 24.6. So that was an interesting tidbit. Why biotech is poised for recovery, we've covered that, but now consensus is starting to agree with us. May, so 8 months after it bottomed. Investors are holding near record levels of cash and may be poised to snap up stocks that we covered in the last chart. And when retail's flushed out, that's usually a good time to be buying. Here's Tom Lee is back talking about a 20% rally this year. We I don't know about 20%, but certainly more than most people are positioned for. That's for damn sure. Inflation continues to fall. PPI fell 0.5% compared to 0.1% gain. And on a 3-month annualized basis, PPI is running just over 1%, which will help and drive inflation back down to the Fed's long-term 2% target. Recent data argues the Fed is too hawkish as inflation data is showing clear signs of easing. Bond market argues the Fed needs to end the war soon. First, inflation, 2 things need to happen. First, for big gains this year. First, inflation data needs to continue to track at this leg down level, and we expect less than 3% annualized inflation for the next 6 months. Second, Fed needs to own up to this, quote, leg down, which bond market already sees. I think the 10-year yield got down to like 3.3 something yesterday. Mind-boggling. Bond market already sees this. The Fed is in la-la land, apparently, based on the rhetoric yesterday, although Lael Brainerd came out today much more moderate, and that caused the market to come up nicely off the bottom. So today, let's see. This is not, okay. Fed needs to own up to this leg down, which bond market sees. This is not true if the Fed is willing to push the economy off a cliff needlessly. And they're right on the edge of that. A lot of stupid rhetoric coming out yesterday. And the good news is those people have no votes, so they were just spectators. The bad news is the algorithms have not been reprogrammed for voting members this year, I guess. But they got to get to it. So Fed has already turned less hawkish than it was for most of last year. That's correct, with most of its recent hike being 50 basis points rather than 75. It got comfortable with during 2022. Fed is expected to hike rates by just 25 basis points at its next meeting, and a pause in rate hikes could come soon after that. So you got February, and then you have the mid-March meeting. Okay. So he also says 53% of all post-negative years are up more than 20%, meaning high odds of a greater than 20% rise for the S&P in 2023. That probability of a more than 20% gain this year rises to 90% if the S&P is up more than 1.5% in the first 5 days of the year, or if the VIX average is below 25, which it did. So all of this is constructive. Okay. Activist investor Ryan Cohn takes stake in Alibaba and pushes for more buybacks. So the guy made $2.5 billion on Chewy, which is the pet food thing that ships pet food to people. And, he took it and cleverly he put it in 3 stocks. Wells Fargo, I think Wells Fargo, Apple, and Amazon, if I'm not mistaken. Those were the 3 businesses, I guess $800 million each or whatever. And then he also has some Citigroup, Apple, Wells Fargo. Anyway, long story short, it came out that he bought about a few $100 million of Alibaba recently, and he's pushing them to do more buybacks. So he did GameStop, he did all this, but I think this is more like his investments in Apple, just buying high-quality business that he knows are going to compound. And now he's pushing the activist front like he did with GameStop. The benefit of that, not that it'll work, but what may happen as a result of this is what you saw in GameStop, which, didn't have the same fundamentals, so I don't want to keep comparing it. But what happens is opinion follows trend. And if, like the other businesses he was involved in, retail investors get very excited about it, the common denominator is most retail investors don't have a lot of money. So what they do is they try to force big outcomes with options, and collectively they have a ton of money. So, but they're all putting it in options versus stock. And what happens is when the dealers sell the options, they have to buy the stock to hedge. And we saw this with Paramount Global, with the Archegos. We saw a lot of gamma squeezes over 2020 and 2021 with GameStop, with AMC, with Paramount, etc. And what could happen is the more the stock goes up, now that Ryan Cohen is involved, and to the extent there is that swarm of retail people still involved, you're going to start to see a lot of call options. And when, millions of contracts of call options are sold, dealers have to buy millions of dollars of stock to hedge. And the more it goes up, the more stock has to be bought to hedge out the premium that was sold. And that can create a squeeze and get us to intrinsic value much more quickly than would happen on its own. So there's a potential catalyst. Now, the stock is really big for this type of thing to play out, but the more it goes up and the more noise it is around, Cohen can only help. It's like someone said, what do you think of Cohen being involved? I said, it's just noise, but happy to have him on board after a big move here. That said, if it does attract that crew, we may get to our outcome of intrinsic value much, much sooner. And to that point, when everyone wants the stock, and we'll help them out. It's very far off from here in terms of price. There's a lot more to go. But this could be a potential catalyst to get there much sooner than I would have expected. So just because of what structurally might happen in the market. So we'll see. Boeing 737 MAX takes off from China for first time in nearly 4 years. Good news keeps coming. So this is all the China stuff. Meme stop icon, Cohen buys into Alibaba and rare China activism. China property crisis, Beijing drops 21-point plan to aid developers with financing. So it's game on. History repeats itself over and over in China. They overlend, they crash, and then they say we'll never do it again, and then they do it again. Why? They don't want riots and they don't want to be overthrown. So Chinese provinces mostly target growth of 5% or more in 2023. That's in line with what they set for the country, which they're going to probably blow past. Alibaba drives deeper into autonomous driving market with Geely partnership and smart car systems. This is related to their semiconductor expertise and other expertise, and you don't even know. Like they've got their hands in so many incredible pots and so many outs. Like we say in poker, you have outs. It's like we're playing this game for AWS, not in that order. Not AWS, Ali Cloud and Ant. By the way, there's an unbelievable e-commerce business which the government is pushing domestic consumption now. And then you've got all these things like the Costco of China with the supermarkets we covered that they own yesterday. Autonomous driving, who's even thinking about that? The chips. So anyway, a lot of outs, a lot of exciting stuff happening, and now some structural thing that may even accelerate and add fuel to the fire. So Chinese Premier Li Qingshan expresses support for platform economy. Okay, so more of the same. China's government is buying Alibaba and Tencent shares that give the Communist Party special rights over certain business decisions, report says. Okay, now this is a big thing because I got an Ask Me Anything question from... By the way, Brian asked about if there's a deadline for an announcement regarding the refinancing with CPS. They have 4 days to file. Like I said, I think they're, assuming it was completed, I think they're going to pay off the old stuff, have the 4-year runway in place, and then announce that it's all done once they have all the numbers. So best guess, I would imagine, tomorrow or tonight or something like that. But maybe they leave it off till Monday when there's more action. Can you give us... okay, so the question was... okay. All right. Well, okay. So the person asked, are you worried about the golden shares? Okay, here we go. From Andrew Lair. Hi, Tom. Thank you for all of your amazing work. Do you see the Chinese government buying shares of Alibaba and Tencent as a good sign or a bad, and why? Well, first thing I like to ask whenever someone proposes a deal is, how much skin in the game do you have? So, how much money are you putting up? Now, if the Chinese government confiscated these shares and just took them and said, we're going to have 1% of the company, whether you like it or not, that would worry me. But instead, the Chinese government wrote a check for 1% of this business and got a seat on the board in exchange. So the fact that they actually wrote a check for the equity and paid for it, I like, because they're now a partner. So rather than being an adversary, they're not going to flush their own investment. They're going to be incentivized to make sure the business does well. That's not to say that all of their decisions are going to be ideally what Alibaba would do on their own, but it's a trade-off. It's like if the ship's going down, you're coming with me, and I like now that they have skin in the game. So for me, it's a net positive, and the stock traded up on that news, and that tells me what I need to know. China's revenge spenders are just warming up. We agree. We saw it in the U.S. in 2020 and 2021. Just imagine that with kerosene added to the fire. It's going to be mind-boggling, because we weren't locked up for years. We were locked up for weeks. China's economy could recover faster and earlier than expected, analysts say. Opinion follows trend. So they only needed a 100% move in the equities to get excited. Chinese stocks have been on a tear. Morgan Stanley says it's turning even more bullish on China. Even more bullish than when you said they were uninvestable, asking for a friend. So big change from uninvestable to overweight. You just can't make this stuff up. Nearly all of Beijing to get COVID by end of January, study finds. So that's good. There was another good in the sense that they'll get on with it. Not good for the people that, they could have done it better. Obviously, they could have just said, all right, we'll buy 200 billion shots of the mRNA. We'll jab everyone in December, and then January we'll let people go. But instead, they just said herd immunity overnight. So they went for that. That's fine. That was their choice. Don't know if it was the best decision for their people, but it is what it is. It's done. And the reports say that it peaked in most areas in January 6th. So basically, everyone had it by January 6th. U.S.-China trade is close to a record, defying talks of decoupling. Facts speak louder than words. Everyone's saying deglobalization and we're enemies, and yet even in the worst possible circumstances, we did more trade than ever. And I think that's going to go up. China Vice Premier Liu He says country open to foreign investors. So China's economy will be on fire in the second half. Standard Charter chairman says it's just mind-boggling. All the same people who said it was uninvestable are now the cheerleaders. Wait till you see, if you think people are excited at 115 or 120 bucks, wait till Alibaba's at 250. The people you're going to see that get bullish on Alibaba at $250 are going to blow your mind. And I'm going to actually pull up the videos when they were telling you to sell it in the hole. And that is going to be a fun podcast. My guess it'll be episode, where are we? Maybe as early as episode 220 or 230. And we'll cut back to the tape. China's vice premier says growth rate can recover. China says economy to return to faster growth as COVID isolation ends. China set for steady, continuous foreign capital inflows as overseas investors return amid reopening. China is open again. 13 ways to tap into its recovery right now from our our friendly China bull at Barron's, Reshma Kapadia, who's been writing some very positive articles on China of late. China tightens media control with tiny stakes in 2 Alibaba units. It's amazing how these are framed. Another way to look at it is China writes a big check to buy 1% of the company and gets a seat on the board as a result of the investment. How's that? How's that for like facts? Here's from Brendan Ahern over at KWeb ETF. Mainland China managed small gains as the vice premier speech at the World Economic Forum in Davos garnered significant attention from mainland financial and media. In 2023, Vice Premier stated China will, quote, continue to implement a proactive fiscal policy and prudent monetary policy, focus on expanding domestic demand, welcome more foreign investment to China, and prevent and diffuse economic and financial risks. That sounds good. The government will, quote, unswervingly support the development and growth of the private economy, persistent opening up to the outside world. Okay, so that's that. I mean, it's all out there, folks. They can't walk this back now. Moving right on to the article of the week, stock market breather and sentiment results. After a 14% move off the October lows, the market has been consolidating sideways for the past 6 weeks or so. This is a normal consolidation and will resolve itself higher in our view as we work through earnings and the Fed meeting in the coming weeks. For the next few days, who knows? Okay, so here you had 14.5% move off the October lows. By the way, we were on with Mitch on the day of the low with a bullish outlook saying that we'd get to 4,100, which we did before the end of the year, which we did 40.80. I said 4,100 to 4,250. We got to 40.80. We're consolidating that sideways here the last 6 weeks. Okay, so we went through that. Now, the core tenet of the bearish argument is that the S&P is trading too high of a multiple and the multiple must come down as earnings slow. We believe that estimates are too low for 2 reasons. So, first off, you can see where earnings are headed. But second off, China has 5% GDP growth target. And I think that's going to be exceeded because there's a lot of pent-up demand and they've got a lot of backlog of stimulus they've been doing since last March, which we've talked about. And the 10% decline in the dollar should add about 5 to 8% to S&P earnings that are not yet in the models. No one's really talking about that. Even excluding those factors, the path of least resistance is up. Everyone's talking about, well, you can't have a 17.1 times multiple, which is 2023 earnings, if earnings are going to slow and the market. But the fact is, after tech reports over the next couple weeks, earnings season's over, which means 2022 is gone. And we've got 2023 and beyond guidance. So on current year, it'll be 17.1. But when you look at forward 2024, which is 252 on the S&P, you're only trading at a 15.5% earnings growth rate with 15.5% PE multiple, 15.5% PE multiple with 15% earnings growth. 10% earnings growth from this year to next year. So we think that's positive. And for those who claim 15.5 times next year is still too high because rates have gone up, keep in mind the Fed funds rate during one of the biggest gaining periods in the stock market in history from 1995 to 2000 was over 6%. You can see it right here. And look what happened to the NASDAQ. No one wants to touch any tech with the 10-foot pole, even earning tech with high cash flows. Well, think again. Not to say that because rates are high, tech must do well. That's not true. But it's not to say because the Fed funds rate is 4%, tech can't do well. I think some tech will do well. The highest quality that are cash generative that have been cut in half. We've talked about Amazon, etc. So, okay, so that's that. And for those who say earnings have to come down, well, earnings bottom 6 to 12 months before. The stock market bottom 6 to 12 months before earnings bottom. So if you still think earnings are coming down in another few months, that points right to October of last year being the bottom in the stock market. Sentiment. 5 key takeaways from the Bank of America survey. Managers have less risk in their portfolio than at the bottom of the market in the early 2009 during the great financial crisis. Takeaway 2. Investors feel the Fed policy is too restrictive now. Three out of the last four times when they felt this way, it was the time to be a buyer of stocks, not a seller. That was at the pandemic lows. That was at the Euro debt crisis lows in 2011 and the 2002 lows of the market in November of 2002. The financial crisis, which was a once-in-a-100-year credit event, was the exception. China growth outlook is positive. This sentiment is consistent at the early stages of previous major rallies in China equities. Lowest U.S. equity allocation since October of 2005. The last four instances of managers being this underweight equities were times to be a buyer of equities, not a seller. And recession fears peaked in November. The last two peaks in fear were at or slightly after major market bottoms. So the last peak was April of 2020. The bottom was in March. We just had this peak in November. The bottom was in October in our view. And then you had it in March of 2009 at the great financial crisis lows. Managers are now underweight tech and equities and overweight cash and bonds. I'd take the other side of that. Certainly start to get some tech exposure on a selective basis and certainly equity exposure while everyone's still fearful. Okay, so we see, inflation rolling over. The data's weak. The Fed can declare victory. Rather than come out, okay, so we went through all of that with the Fed talk. You can read that. Looks like a 25 basis point hike. Sentiment is improving. It's still neutral. When the bull minus bear was this inverted, you had major rallies in the next 12 months. This is from Matt Sermonaro. Next 12 months was, so last time this happened was at the pandemic lows. You had a 51% in the next 12 months. Then you had 2009 or 2010, you had a 13%. Then in 2009, you had a 53%. And then in, looks like 1998, you had a 19% rally. So again, just more things pointing to when things get this extreme, there's opportunity. Here are the earnings, top 30 weights of the S&P 500 over the last 60 days. They've come down by 1%, the 2023 earnings, so basically flat. That's good. Same thing with the Dow. They've come down by less than 1%, 67 basis points. So earnings basically flat. Market's still suppressed. That sets up as an opportunity in my book. Then you look at just general earnings. Morgan Stanley knocked it out of the park because they have the consistent business of the financial advisors. Goldman Sachs, S the bed, for lack of a better word. Why? Because they're dependent on deal activity, and they screwed up trying to go into the consumer business with Marcus, so they had to take big write-downs. But it's Goldman Sachs. They'll figure it out. Some other ones. Let's see. Wow, this is mind-boggling. New Oriental Education, EDU, which was one of the companies that was shut down, the online education services shut down by the government last summer as part of the crackdown. They basically modified their business and they beat on the top and the bottom line. Talk about resilient of these Chinese businesses. I mean, this was a sector that literally got shut down and these guys have figured it out. So if they can do well with their hands still tied behind their backs, imagine what the other businesses are going to start doing with the country reopening. That is pretty exciting to see. Procter & Gamble beat on top and bottom line. Netflix we'll see tonight. What else? I think that's it on the earnings. On the economic data, the Chinese economic data came in better than expected. Fourth quarter GDP was 2.9 versus 1.8. That was with major shutdowns and unrest. I mean, this is when they were, welding people into their own apartments, if you remember from the news. Mind-boggling. Industrial production came in better, 1.3 versus 0.2. And the thing is, everyone says, well, you can't trust Chinese numbers. Well, when the numbers were like negative 10%, no one said, well, you can't trust them. Maybe it's negative 20%. So, I mean, you can't have it both ways. I mean, retail sales were negative 1.8% versus negative 8.6% estimates. That's pretty exciting. I mean, if they can do that kind of business with the country shut down and all the political nonsense that was going on in the fourth quarter wait till we see what happens in the second quarter and the third quarter when things normalize. I mean, it's exciting. Unemployment rate was 5.5 versus 6%. New York State Empire Manufacturing, this collapsed, negative 32. Fed needs to be paying attention to these numbers, and they need to, if they've got to do this 25 basis points, they should do 0. But if they've got to do it, they should just say, we're not attached to any particular number. This may be it, or it may go, one more or something like that. That would be the language. Or we're just going to keep it elevated. And if we need to do one more, we'll do it. But I think if we keep it elevated, starting now, we may be able to keep it elevated for many years. If we hike too soon, then we're going to have to go back to cutting. Core retail sales, again, these are all signs to the Fed. Wake up and let up, because, one mistake was enough. 2 is not acceptable. And we'll see if they get it right here. They're on the edge of really pulling off something amazing, but they could just, if they go a little too far, they're going to blow it. Okay, so continuing jobless claims stayed at 1.6. So the job seems okay here, but we'll see going forward. Big build on crude inventories. That was interesting to see. All right, so now we're going to get to, this is the sector earnings. Again, everyone's chasing energy and materials. They're going to have the worst results this year in terms of earnings. No one wants consumer discretionary and commercial communication services coming off a low, and they're going to be among the best. So keep an eye on that. Now, let's do a couple of Ask Me Anything questions, and then we'll be done. Ish Singh. Okay. Hey, Tom. Thanks for your amazing work and solid advice. It's opinion, not advice. Go to hedgefundtips.com. Click on terms. Don't know your financial situation. Talk with a financial advisor, etc., etc. I often watch your weekly VideoCast twice to make sure I'm able to reap as much as I can from them. I've been watching you for almost a year now. I'm finally submitting my first AMA. I know we're not in the business of speculating or timing. However, given the run that CPS has had in the past month and your expectations for how it might trade flat after the refinancing is priced in, would you consider selling some shares now that it's not 50% of the portfolio yet? It will be shortly. To add equity positions like BABA Biotech, which may yield higher returns from now to the end of the year, now that CPS is trading at more reasonable value, and given that EPS may take a while to ramp up, do you see more potential in other positions in terms of percent gain? I don't play that game. I'll be holding this until they're earning what I think they should earn on a normalized basis, and then I'll determine if the multiple is despondent or euphoric, and if it's anywhere near euphoria, I'll lay it off. When everyone wants it, I'll help them out. Right now, no one still wants the stock, so they're not getting it. Okay, I had to help them out when they wanted to get rid of it at $5 and $4 and $3. We helped them out. Okay, they were dumping it in the streets. There was blood in the streets. They couldn't give it away. We had to help them out. We got in at $5.50, and we're nowhere near the point where they really need to get on board and get as much stock as they want. So we'll be sure to help them out once they're ready, and we're nowhere near that. So I don't care, if they put out a press release and the stock trades down, they put out a press release that the refinancing's done and the stock trades down on a sell the news. I hope it trades down a lot. Maybe I can pick up a few more shares, but it also might trade up. So I can't predict. I don't care. I'm in this stock because I think it can earn $5, $7, maybe $8 a share on a normalized basis, because they're going to get more margins from the EV cars moving forward. And $8 at 10 multiple is a lot higher than now. At a 20 times multiple, it's really a lot higher than right now. So no, I don't play those reindeer games, because what if you dump and it goes up to 25? Then you missed 100% of the move, and instead of having an 8-bagger from here, you only have a 3-bagger. That just makes absolutely no sense. I got more people contacting me, asking me if they should buy more when it was at $14 and $13 than when it was at $6, $5, $4 when no one wanted it. And it's just I know a lot of you guys are learning, listening, but you got to buy when there's blood in the streets. And No, I don't. By the way, if the stock does nothing or goes down for the next 24 months and it winds up at $80 or $100, do you think I care? It's the IRR over time. It's the internal rate of return. So if it's 800% over 3 years and that all comes in the last 6 months, I don't care. Or if it comes in the first 6 months and I'm not in because I'm trying to be cute about $3, that's just not the way to play it in my view. But look, be cute. You might win. But I think it's a good question and hopefully helpful to a lot of people. So number one, thanks for listening. Number two, a lot of people are thinking that same question. I can tell by sentiment. And I don't want to play those reindeer games. I want to own this thing until it's at fair value. Ross, interested in investing. Okay. JT asked a question on the two British stocks. We're not talking about those publicly at the moment. That's reserved for clients, and we got to finish our work. AJ Enos, I'm lucky to be a listener since September 2022. After following along a few months and my own due diligence, I took long positions in 3 of your most talked about companies, and the results have been positive to say the least. Becoming a pain. Okay, so that's that. He's joining the trade service. That's great. Thank you, AJ. Nikolai, AMA question. Thanks for a very good podcast. Was wondering if you could give your thoughts on the company Rumble On Inc., ticker RMBL. All right, let's take a quick look. First off, here it is. It's traded down. That's good news. Looks like technically it looks like it's going to bounce. Let's see if I'd want to own the business. Negative cash from operations. Gross margins are increasing, so negative, positive. Revenues are increasing. That's good. Negative EPS. Let's look at the financials. Revenues are going parabolic. Gross profit is good. Their operating income is meaningfully negative and growing negative. They've got positive EBITDA for the first time. Diluted EPS per share. So they're going to earn some money. Let's look at cash flow statement. Earn a couple bucks in cash from operations. So this is kind of a turnaround story. The business is getting better. The price has gotten worse. For me, what they do is they buy and sell vehicles. I think used cars are going to be an S show this year. I think the game is going to be new vehicles. So let me just see here. I know the CEO, I think, of CarMax was in buying stock, and some of the people in Carvana were buying stock. On those, I'd probably want to buy the debt and trade it like a zero coupon bond. If the debt's trading at 50 cents, I might buy, take the amount of money that I want to put into the position, do 50% in the debt with, a 30% yield because they're triple C now, and then maybe the rest in equity. So if the equity gets wiped, I still have a chance to be made whole on the debt. And basically, if I'm wrong, I come out whole. If I'm right, I get a double on the debt. I collect the yield in the meantime, and maybe I get a 5-bagger on the stock on some of these used car website type things or dealer type things. But what does this thing do? Distribute pre-owned vehicles in North America. Yeah, I wouldn't touch it. That doesn't mean it won't go up. It could very well go up. There are others I would look at first, but I think the thinking is okay. I think you're going to be early on that. I think the demand is going to be for new cars this year. A lot of pent-up demand, and what's going to happen is, if you go to get, quote, pre-qualified here, they're going to say, congratulations, 8 or 9%, whereas you're going to start to see GM and Ford and all of them come out and say, hey, come on down. We know your car is 13.1 years old. We're going to do 0% financing for 24 months. Or 2.9% financing and an 8%, and everyone's going to say, oh my God, I need a new car. Oh, and by the way, we're not selling above sticker anymore because we've got a lot full of cars because the semiconductors have been rolling since June, and the game is going to be on. As far as someone asked me about the markdown in prices, Tesla did a markdown to gain volume. I think this is hugely bullish for Cooper Standard because GM and Ford traded down on that because they'd have to, the theory was they would have to cut their prices. I don't think that's true, but let's assume that's true. And then they have dealer incentives. You're going to see massive volume. And it was just a question who was going to blink first. And I remember talking with someone. I said, look, GM and Ford may be controlling supply so they get higher margin, and they've just enjoyed this halcyon period for the last 2 years. But Hyundai's not sitting on their ass. They're going to come in and they're going to undercut the market, and Kia's going to come in and undercut the market, and then they're going to get fear of loss because they're going to lose share, and then everyone's going to be cutting. Where does Cooper Standard make money? They don't care what GM and Ford's margins are. They care about number of cars, because the price of the sealer per car, in order for them to sell the car, and the fluid delivery system and the brake delivery systems are based on number of cars, not on how much did GM and Ford make per car, just how many units went out. And the lower the prices, the more units are going to go out. So Tesla, who is, by the way, a client of Cooper Standard, did the whole industry a favor, and they blinked first. So now, hopefully, everyone starts to blink, and the volumes go out like crazy. Used cars will get crushed. New cars will go like bananas, and Cooper Standard will make coins. So that's our thinking there. Okay, Kyle M says, should we be taking shots at companies that have declined 50% over the last 2 years versus successful companies over the last 2 years? Okay, so he's talking about Twilio, Teladoc, Carvana, and Shop. Carvana is very risky. I told you if I was going to be involved, that's how I would do it. The only reason it came across my screen is because one of the insiders was buying stock in November after the stock had collapsed, 95%. They basically got enough cash for 12 months. That's super high risk. I don't know if I would even take it, but if I did, that's how I would take it. Shopify, Twilio, and Teladoc, I think I've looked at them. If I'm not mistaken, they're all losing money, and I don't want to touch any business that's losing money in this environment. I want cash generative businesses. So let's see. Yeah, I mean, if you look at these technically, like Twilio, they look a little bit attractive because they're down so much. And they, again, just because I'm not interested doesn't mean they won't go up. I'm just saying I like to put, it's back to that Warren Buffett thing. I just keep my bat on my shoulder until the fat pitch comes down the middle. And people will yell, swingy bum, and that's fine. You make more money in this business from the things you don't do than the things that you do, because that keeps you in the game. And when that fat pitch comes down, you can lean into it and absolutely knock it out of the park for a grand slam. And you only need a few grand slams in a career, and you annualize that performance, and you're well above trend, and everyone's happy. So this is not. Let's just take a quick look. Twilio. I don't even need to look at it because we just saw it, but all right. Revenues are growing. They're just losing money. I don't want to be in money losers right now. So Twilio's off the table for me. Teladoc, which I think is a commodity. I think all the insurance companies are doing it on their own now. Let's see. All right, so they're turning cash flow positive. Also, Robin asked on YouTube about PayPal. We covered that a few episodes back, so you can check that out. She also asked about Square. Square is the same story. I personally wouldn't do Square. Anyone that changes their business they changed their business to be called blockchain when Bitcoin was at $60,000. Anyone who chases fads like that, for me, is a leader I don't want to follow. So I'm just a hard pass. As much as I know they've got Cash App and it's a decent business, I'd take a closer look at PayPal, which we did. Haven't done anything with it, but if gun to the head, that would be the one that I would take. I'd take a hard pass on Square. Doesn't mean it won't go up. Again, here's a great business, still losing money. Teladoc, pass. Next, your question was Carvana. We covered Shop. Shop keeps coming up, Shopify, and I keep doing nothing. I mean, part of the question is, what do I want to sell? Am I going to sell BABA? No. Am I going to sell Cooper Standard? No. Am I going to sell Biotech? No. Again, this one's losing money, so that's easy. Exxon, pass. I've covered energy in the last couple of months. It'd have to come in a lot for me to get interested again. Apple, it's trading at 26 times. Its historic multiple is like, I don't know, 17 or 18. I think it'll do fine, but it's not going to do exceptional. It's not going to do poorly. It's a great business. It's just not for me. Jarrett, hey Tom, was able to get some CPS in the low 6s and 10s. Do you see another potential drop where adding more would still be good? I don't know. I have no idea. I don't even think in those terms. All I know is I bought as much as I could ever want, and we got in at 550. It would have to drop back to 550 for me to even look at it again. So that's not the way I think about things. So I wouldn't count on that, but nothing's impossible. Also, as Chinese stocks, any takes on NIO? I'm agnostic. I'd rather be the arms dealer than the, if you look at the 1920s and the amount of car companies that were, Packard was an incredible car. My dad always talks about it. It was his luxury car. It was the greatest. But thousands of auto companies went bankrupt. So I don't want to play the game of picking winners and picking losers. Is it going to be Geely or BYD or Tesla or Ford or... I just want to be the arms dealer. I want to sell them the sealer that goes around the doors. I want to sell them their cooling systems that you need more of for their fuel delivery systems, their brake. I want to sell. I want to sell to all of them. Okay. I hope they all do great, but I know only 2 or 3 are going to survive, and I don't want to make that gamble on who it's going to be. I mean, I look at all the pictures of NIO. I think they got cool looking cars, but I'll let the market vote for that, and I'm not going to predict it because I don't have a crystal ball on that stuff. I have a crystal ball on buying businesses that are temporarily impaired, that have years and years of track record, that have a moat around their business that just fell out of favor in the Wall Street fashion show, and I know they're going to revert back to their mean. And those I can buy all day long, and quote unquote crystal ball. It doesn't take much predicting at all. It just takes some, gonads, so to speak. So pass, not pass. I think it could work. I just don't know who's going to be the winner. It could be NIO. I don't know. You probably know better than I do. So I like Chinese stocks. As long as they're doing decent, they should get. Rising tide should lift all boats. Eric says, can you give us a sense of when the next catalyst is for CPS? Yeah, it's going to be March 17th at 1 p.m. The stars and the moon and the sun are going to align, and then it's going to go to $40. I mean, I have no idea. What I do know is once we get the press release that the financing is complete, they have a 4-year runway for the industry volumes to revert back to normal levels. We think they're going to be above trend for some time, playing catch up for the next few years. So I think that the industry volumes are going to do better than everyone expects. And then if this Tesla cut practice carries some weight, that's going to be exciting because volumes are going to go through the roof. If people can get cars at a discount to sticker and get dealer incentive financing for new cars, I mean, that's going to be a home run. And if you want to buy a 2-year-old Range Rover, you probably get it at a 70% discount a year from now as the market gets flooded with new cars, and CPS is selling the sealers for all of them, which is exciting. So that's the game I want to play. With that said, we've run a little over here, but I want to thank you for tuning in. I hope you found this helpful. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.